Welcome, everybody. How we doing? Doing good, doing good. We had a fun little day today. Voice chatting today. It's pretty boring most of the day for me, though. I hit a nice one on Amazon early. Fumbled that, but we were right place, right time on Amazon, thankfully, right off that daily trend down there. Old double bottom from yesterday. We were long this thing right down here. Fortunately, I was selling it like right here. Yeah, it was outside of the bands. It was outside of all bands. Apple was also doing the same thing. Can't wait to hit some bands tomorrow. I love hitting the B band trades on Friday. Too fun. Well, I mean, they either you either get paid huge or lose it all, but it's still pretty fun. Fridays are just fun trading. I think I'm finally getting people on board and realizing that you shouldn't be counting on Fridays to make your week. But if you've had a good week and you come into Friday, know that, size down, understand those things can get destroyed. It can be a pretty dang fun day. You either add a little extra profit or give a little profit back, but you generally get to have fun doing it. Yeah, exactly. That's why the casino is fun. We get to do it once a week on Fridays. Nice day out of AES for me. Good candle too. This had me worried though. I deleted it, but let's get over that tomorrow. Let's put in another 3% day on this thing tomorrow. You're telling me. It is funny, we got until, well, I've moved on now, but when is that next expiration? What's the date on this? The 17th, but I've moved on to the 24th. But we got to like right here for it to make a nice move. A lot of candles between here and there. Will say I've been peeling those 15s off every chance I get and rolling them right into 14s for the next month or for the next expiration. Welcome, everybody. We'll give this a few more minutes. This class actually had a really nice attendance last time. I was relatively surprised, but I think that is mostly because so many people are trying to use prop firms these days. But we'll give it a few more minutes and let people show up. But how'd everybody do today? We all have some fun? I know both of my VCs did all right. Nando did tell me he took the stop out in pro. Unfortunately, I ended today, but whatever. He had a sick morning, I think. So that's the way it goes sometimes. Yeah, yeah. It can be honored for those end of days. But, that's actually, it's so funny. That's one of those things that well, I don't love it, and I don't like any broker that limits you, and that's why I've oftentimes, like been against Webull when you could just use Thinkorswim. I will say, Robinhood selling these things 30 minutes before close for you or whatever. Does it suck sometimes when they work? Yes. But also in a weird roundabout way, they sure are protecting their customers. Because, I mean, don't get me wrong, I do a voice chat every single day with all of you and today, and we trade in this last 30 minutes. But I won't say it's a good idea. Like, you guys have all heard me. Like, anytime I jump in a voice chat and today, I say, if you aren't green, get out of here. You need to be playing with profits end of day, and understand your risk, so. Well, it sucks that Robinhood closes those out. It also probably say like everybody remembers the ones that run 500% every the end of day, and everybody seems to forget that like 10 before that all went worthless. I mean, that was even it even got me today. We were lucky enough to catch this green candle or whatever with Grizz, and I held a couple. And you better believe those things are minus 99% here to end the day. That's just the way it goes sometimes end of day. Oh, dude, AES has been so funny, dude. Me and Crash just talking about it all the time too. Finally did hold a green candle. Finally did sell down. I mean, I gotta say, yesterday was where I finally started like peeling most, like sold a lot. Sold a lot the last couple of days. And then I think it was yesterday, maybe it was 2 days ago. Much happier with my entry now on the new contracts. I'm in new date. So hopefully it wants to get up and go. Long consolidation on it. Tried to go to new lows a few times and it's just not pulling it off just yet. So we'll see. We'll see if it's ready to go for us. Even just back up to here, that 1360 zone make me real happy. Welcome everybody. Gotta type up one more post and we'll get rolling here pretty quick. Okay, give me one more second. Okay, so welcome everybody. Happy to have you here, Dirty River. Tonight we are talking something a little bit different. Tonight we're going to be talking about trading futures. And so and as I said in my post, you know, this is not a technical lecture. This is not, this isn't about how to trade futures. Of course, you guys know when I do anytime I do a lecture, I always make sure that uh I bring it back to the charts if I can, because if we're able to bring it back to the charts, that's actually really applicable to what we're doing. And so we will, of course, be talking a little bit of charts as far as futures tonight, but I'll mostly be discussing how they pay and things like that. And so, uh, wow. And so tonight we will, cover what are futures contracts, what do they represent, how do they pay, what are the ways we can use them to our advantage, what are some of the disadvantages of them, what are the requirements to even be able to trade them. And so tonight, we're going to be talking futures. I know they aren't for everybody. And the reason we're kind of talking about them, and really the only reason that I even talk about futures, is because of prop firms. And so there's so many people trying to, use prop firms and think that they're the greatest thing ever. And so we're going to touch on those a little bit tonight. Just what they are, how they work, some of the things involved with them. I'm gonna kind of try to remain unbiased on them, but give you my honest opinion of what they are and what they've done to trading. But so with that, we'll get rolling. As always, mics are unmuted if you want to unmute and ask a question. But shouldn't be too difficult. So futures, what are they? Why do we trade them? What's the advantages, disadvantages? Futures are nothing more than another way to trade some of our major markets, whether it's things like the S&P or the NASDAQ or commodities. Commodities are really what got the futures market exploding. And what do I mean by commodities? It's going to be things like your gold, your silvers, your oils. All of those are commodity trades. Is there other ways to trade oil? Is there other ways to trade gold and the S&P? Of course. Futures was just one that it's been around for a long time, but it really, really exploded in the, 70s, 80s, 90s. We've all seen those videos of, people on the New York Stock Exchange or at the, CME, Chicago Mercantile Exchange, uh, standing in the floor, yelling, throwing papers around, doing hand signals, all of that stuff. That was futures trading. That's what most of those people were doing. There was also stock pits and all of that stuff, but the crazy pits that we see out of the 80s, that is mostly futures trading. Futures trading is, it's a way for people to trade some things that are a little bit more difficult to trade. Because we've talked about, just so far we've touched on, S&P, NASDAQ, gold, some of those major things. There's futures on anything. You want to get out there and trade soybean futures because the US is selling no soybeans. There's soybean futures. You want to trade chocolate, you want to trade sugar, orange juice. You can trade hogs, you can trade pig futures, beef futures. They have it for literally everything. Charts are the same. You will, in certain of those markets, of course, run into liquidity issues. So, tonight we aren't going to be talking about orange juice futures. There's just not enough people out there trading the orange juice futures that we really need to worry about them. And so the first one, oh, hello, Tater. And so the first one we're going to talk about, it's going to be the big one. People, I trade this. This is what most people trade. I won't say most people, but it is definitely one of the more liquid futures things. And so, what is this? It's ES. You might hear some of the few people that do trade ES, me, Joe. I think Nando even trades them some a little bit. Or the people trading prop firms, they're going to talk about ES. There you go. Another person, Wax, Waxui, if anybody's in pro, I don't know if that's actually how you say his name, honestly. But if anybody's in pro, he will often reference the ES chart. And so what is he talking about there? He is talking about this. And so on Thinkorswim, it's going to be /ES. If you want to trade futures on Thinkorswim, most of the time you're going to see them as ES. Sometimes you'll see them on like sketchier prop firms listed as US 100, things like that. But the real thing that we're going to be trading is going to be something like ES. And so what is ES? It's the S&P. It's similar to SPX, it's similar to SPY, it's similar to all of those things. SPY, obviously a weighted ETF. The price of SPX is calculated based on market cap, same as ES. ES is going to be overall market caps of those stocks with no heavier weighting towards any of the, towards any individual name having a bigger role in what it does. And so, what's something, interesting or different about that? Sometimes you will see, SPX, for example, setting a new all-time high, but SPY won't have set a new all-time high yet, or the other way around, whatever it might be. Well, ES is just what we trade futures if we want to trade the S&P. So we've decided we want to trade futures and we decided we want to trade the S&P, so we have the ES chart up. Well, now we have to decide how we want to trade it. So you might have heard people talk about E-mini or E-micro. What those are futures contracts. However, contract is a little bit deceiving of a term because we think of option contracts and we think of, for the most part, we think of short-term expiration or short expiration options contracts. Well, a futures contract is very different. A futures contract is, it's still similar to an option where, you have the right but not the obligation to fulfill this contract, whatever it might be. On an option, it's going to be 100 shares. On something like ES, it's going to be, just a cash settled sort of situation. Well, while they are different than an option contract, they are still technically a contract. So we're going to talk a little bit about expirations of these things, you know? And so what do we mean by expiration? It's the same thing as an option contract. You know, if we buy a same day SPY, we know 15 minutes after close, it is either worthless if it's out of the money or worth something if it's in the money. And so where a futures contract is different is they only expire quarterly. So it's funny that we're doing this lecture tonight. They actually expire tomorrow. Well, what does the expiration mean? If we are in a futures contract and we are, say, we're long, and you know, say we longed whatever this is, 66.40, and we're trading at 6,700. We are just going to be cash settled that difference in price. And depending on which contract we have, we'll touch on that in a second. You're just going to be cash settled. Well, there's a couple little unique things that happen with these. And so on something like, you know, ES or /NQ, that's going to be your NASDAQ futures, you're going to be cash settled out. On something like gold, it is a bit of a different situation. So this is the gold chart. You know, oftentimes this is what I'll reference. And so this is going to be /GC if you're trying to trade gold futures. I'll reference the gold chart for the price of the ounce of gold, you know, just out of interest and things like that. Well, here's the difference. When our gold future contracts expire, these actually have a commodity attached to them. So say we're long gold at 3,600. Well, that's great. You know, that's great. And so this contract's coming into expiration. If we are still holding it, then and we let it go into expiration and it's going to be, you know, they call it fulfilling the contract. If that contract is going to be fulfilled, each individual gold contract that we have is actually representing 100 ounces of gold. So if we hold this futures contract into expiration, and we're, you know, we have made money, we're making money on it, we are agreeing to buy 100 ounces of gold at $3,600. So that means that you need to have $360,000 available to take your order of gold. You know, you have agreed to buy 100 ounces of gold at 3,600 bucks. So in something like this, you are always going to want to exit that trade long before this comes up, unless you're trying to be the proud owner of 100 ounces of gold, you know. But you are always going to want to exit this before it comes up. Same as an ES futures contract, you are always going to want to exit that before it comes up. Well, people say, what if I don't? And so I want to give you an example. You know, as I said, option contracts expire quarterly. So this is the current option, or this was the you guys are making me laugh. This is the option contract that expires in September. So you see up here, ESU 25. All that means is S&P futures that expire in September. So these things are expiring tomorrow. Well, the next futures contract is going to be ESZ 25, and it will expire in December. So how do we know when to switch contracts? And you can see it in the chart. There's a bunch of ways to decide how do we know if people are switching contracts? When should I stop trading ESU and start trading ESZ? Well, we see it right here. 3 days ago, volume is cratering on these contracts. 3, 4 days ago on the new contracts, the ESZs, volume is skyrocketing. So we know for the most part, people are switching to the new contract and we as well should be switching to the new contract. So does everybody get that and understand? Yeah, there you go. I had it happen to me on 10 contracts at T one time. I woke up the proud owner of 1,000 shares on Monday. I didn't expect that. But so it happens, you know. And so does everybody get that? Everybody understand what these are? It's just a different way to trade these things. So as long as everybody gets it, we'll move on to types of contracts. Okay, so we're all good. So we want to trade futures. So now we've decided we want to trade the S&P. We have our indicators. Uh, so if you switch contracts, all you're doing is selling and moving to the next one. So we're going to talk a little bit about the actual buying and selling of, futures contracts now. All you would do is close and just move to the next one if that's what you wanted to do. But so now we have decided, okay, I want to trade futures. I'm actually going to take all these indicators off of here. Again, we aren't discussing trading strategies. I'll point at some things on the chart that say, okay, maybe we want to be long here or whatever. But so now we've decided we want to trade futures. We want to trade the S&P futures. So how can we trade them? And there's two different types of contracts. There's what's known as an E-mini, I mentioned this earlier, and an E-micro. And all of these have it. There's gold minis and micros. There's NASDAQ mini and micros. Oil, all of these have a mini and micro contract. Well, this is where you start to analyze your risk rewards and how much money you can make and how big and how much money you can lose and how big is your portfolio. So people try to make the mini micro thing super confusing. They try to make futures as a whole super confusing. So the best way to think about them is that they're shares. Think of each contract as representing a certain amount of shares. So when we're discussing an E-mini contract, that virtually represents 50 shares. So when we go to our chart, we know if we buy these things at, 660.90 and it goes up $1, because our contract represents 50 shares, we're going to make $50. If it goes $1 against us, and keep in mind this thing trades at $6,700 basically, so $1 isn't very much. If it goes $1 against us, then we lose $50. So when you hear people discussing points, that is what a point is. Say we buy this double bottom right here. Again, this isn't strategy, but we buy our double bottom. Our stops or breaks below there. We're looking for previous consolidation. This is one where it just so happens to happen in one candle. Oftentimes it's not going to be like that, but that means we longed somewhere around, we'll call it 66.90 to make our math easier, and we sold at 6,700. That means it has moved 10 points in our favor. So if we have a mini, we've made $50 for every $1 it's moved, which is 1 point. So we've made $500 here. Well, a micro, the other contract you might trade, is only 5 shares. So this same move makes us $50 instead of $500. These all points are going to be a little bit different. On NQ, they're going to pay you different. On ES, they're going to pay you different. But they will always have a meaning. For example, gold futures, you remember I told you about how, gold, it represents 100 shares of or 100 ounces of gold. That means for every $1 gold goes up and down, you make or lose $100. So that's what a point is. If you ever hear people talking about points, it's really only used in futures. Every once in a while, I'll see people try to say it on stocks, and most people just laugh at that, But a mini on ES represents 50 shares. A micro represents 5 shares. We can also look at the NASDAQ, and the NASDAQ NQ trades at a very large number, 24,700. Well, a NASDAQ contract, an NQ contract, is going to pay you $20 per point, or $2 per point, depending on if you're mini or micro. Well, when we do the math here, because we can always relate these back to something that we're more familiar with. So I always relate NQ back to QQQ, obviously. So in $1 of QQQ is the equivalent of 40 points in NQ. So if you get, your $1 move on QQQ in your favor, or against you, and you're in NQ, then 1 point is paying you 20 bucks. So if you get the whole dollar move, it's 40 points. So you have $800 risk on a mini for every $1 up and down QQQ goes, because the equivalent is 40 points on NQ. So a lot of risk and a lot of volatility. We have individual candles, like, this type of candle on NQ, 36 points can blow portfolios. It can be extremely high risk. And so, most of us, we recommend trading ES if you're going to learn. Most of us recommend trading micros specifically if you're trying to learn these things, because they are very high risk. They are very volatile. Yeah, I mean, even this one, this move on ES, you're talking 47 points at 50 bucks a point. I mean, these types of things can, make or break a portfolio. So the value of each point on NQ again is $20. So when we look at something like NQ, like this move on NQ is just, they're terrifying. You have a 211 point move that happened in all of 30 minutes or whatever. And if it goes against you, you just lost 4,200 bucks. So the risk reward and the ability to trade these is, and until we'll talk prop firms at the end of this, as you guys remember, the ability to trade these and the ability to actually like handle the risk that these present, most portfolios cannot. Don't get me wrong, trading micros you can. Most people don't make the right decision and trade micros and, size according to their portfolio, things like that. So that leads us into our next little bit of how do we buy these, and how does this all work? So when we enter a trade, and there's going to be a bunch of different futures brokerages. Mine that I personally use is Tradevate. I like it more than the others, and they have a very low margin requirement. So if you are going to be trading futures, you have to be on a margin account. However, brokerages will never let, I can't say never, but it is hard to lose brokerage money. They will close out your position when all of your money is gone, and they won't lose any of their own money. Well, on something like Thinkorswim, highest margin rates around, worst place you could possibly trade futures. To open one ES contract, we'll go back to the S&P. To open one ES contract, you need $24,400 in margin. As I said, that's extremely high, but most people can't support those. If you're on Tradevate, you need 500 bucks. Well, you need 500 bucks worth of margin, and most places will base virtually double you up. If you have 500 cash, they'll give you 500 margin, and they'll let you work like that. Well, if you're trading futures and you enter and you have $500 in your account and you're required to have $500 of margin, and you drop to 495, it goes a little bit against you, and you drop to 495, you will be closed out. And it's a margin call technically, but you don't actually have to deposit any money or anything like that. They're closing you out before you start losing their money. I am realizing that I forgot something else, so I do have to backtrack a little right here. When we were talking points. So the other thing you'll hear people discuss is a tick. That's the other thing you get paid by. You'll hear people talk about, I caught 15 ticks or whatever it is. Again, a tick will be different depending on what future you are trading. A tick on NQ or ES is 25 cents. So a point is $1. A tick is a quarter of that. And so, technically on ES, you are making or losing $12.50 for every 25 cents that it moves. If you go to something like gold, where you make $100 per dollar, their tick is actually 10 cents. So you make or lose 10 cents on every 10 cent, or you make or lose $10 on every 10 cents that gold moves. But so again, on ES, if you want to trade these, you're generally, it's kind of prohibitive to trade them without a large portfolio. The double-edged side of it is if you have a large portfolio and you just try to dive in and trade futures, you will likely wind up with a much smaller portfolio than you started with because the risk is so high. So that's why most people don't really trade futures, just as an example, today there was 1.4 million total futures contracts traded. And that's buys and sells and all of that. So, it sounds like a lot, but it's not very many. You go to something like Nvidia, just as an example, and today alone there was 191 million shares exchanged hands on Nvidia. So as a whole, futures markets are relatively illiquid. Just not a ton of people trading in them, because the risk is high. There isn't, a bunch of need to do it. So what are some great uses for futures trading? And why might people want to trade it? And we'll talk about prop firms in a little bit, but why people might want to trade it? Well, it provides you a time to trade that you can't always trade other things. So the futures market is open for 23 hours a day. It closes for an hour in the evening, depending where you live. Open for 23 hours a day. So for people who can't trade during the day, you're actually able to trade at night if that's something that you're more into. Or if there is things that are going to happen that you think could provide some large volatility, in the evenings or in the mornings, you are able to trade those as well. I'm not in any way, shape, or form encouraging this, but when we have those data drops pre-market, one of the ways to capitalize on them without just having to hold an option till market opens and hope it works out for you is in the futures market. If you are big into economics, you study all kinds of things, you understand CPI reports, and you understand how to react to CPI reports, then you can actually trade those reports in the morning before the market opens. Or maybe you want to be involved in the market because there's some earnings after close, and you've done your the best research you can, you've made the best guess you can on earnings. Well, you can trade those micros and see if you get the volatility on S&P or NQ or any of those things, and actually trade them in the after hours sessions. Some other advantages to trading in after hours is it's oftentimes going to be a slower, choppier grind or more range bound trading. So if you don't, and I mean, of course, this is FOMC, but maybe you don't handle volatility like this very good, but slow grinds in the afternoon, you can trade them a lot better and you can, do those things without panicking. And, indicators tend to work really, really good in the after hours. And, it's all because it's so low volume. Those moves are happening much easier. So it can be a really great way to have exposure in the market in times where it's moving slower. You can learn a little bit more about charts. So there is some real power in trading futures. The other thing that you can do is, say you have your portfolio. We've seen a lot of it in OT lately where, full bore long. So any day that, we have pullbacks or people start getting crushed, it's bad days in OT because people refuse to hedge. Well, if you trade futures, you're able to get in there in some of that after hours movement and put on hedges when you feel like it's necessary. So that is a very, very common use from retail traders all the way to hedge funds, using the futures market as a hedging instrument when the rest of the markets aren't open can be a very, very powerful tool. Another one, CL. So what CL is your oil contract. Again, it represents 1,000 barrels of oil. So if you don't have whatever it is, 600 grand or whatever it is to have 1,000 barrels of oil delivered to a warehouse because you want to own them, obviously you want to exit them things before expiration comes. However, the oil market is an interesting one because we, of course, get intraday volatility during the New York trading hours, our 9:30 to 1 or 9:30 to 4. Sorry, I'm on the West Coast. I don't even know what the times are. Uh, well, oil sees volatility day and night because as we start going offline and in America places like that, some of those Middle Eastern countries are coming online. So oil is one of those sectors that provides volatility both day and night. I will say that it's a high risk one to trade. It you make and lose a lot in oil. So, we've talked about points and ticks. So, a tick in oil is 1 cent. So, and you can see here, this looks like a big old move. Well, it's 6 cents, and 10 cents. Well, that's still $100 made or lost in this 10-cent move. So you need to be very, very cautious there. There is, of course, micros as well. They're going to be your MCL. And so they're going to be a buck for every penny that it moves up and down. But it's a place where you can really capitalize on some nighttime volatility. One of the things I will say about it is that, uh, you know, one of the things that I will say about it is that you guys know I preach all the time. The market is not manipulated, at least how people think it is. There's no hedge funds out there trying to stick it to retail traders on their same day spies. They just don't care. That's just the facts. Oil is heavily manipulated top to bottom. They'll release news at the craziest times. They will have the weirdest reactions to news. It is one that if you decide you want to be an oil trader, you need to have, your ear to the ground. You need to be listening to what's coming, what's going on all over the place, because you can get caught in some, very wild movement you don't want to be on the wrong side of. Like I said, this move right here, it's only 38 cents. That's 380 bucks you made or lost right there if you're on the wrong side of it. So you need to be cautious. I mean, this one right here, one big wick, 60 cents, that's a $600 candle right there if you tried to long the breakout, and you get smoked in one candle. So my favorite uses for futures trading are trading at night and using it to hedge. Don't get me wrong, I'm basically never the person that has a bunch of long swings without a short swing open, because you have to protect your money. So it is rare that I am in this situation where I need to get on at night and hedge. But there has been times and places where I've seen some news come out, and I've been very, very happy to, come up, jump on the computer for a second, catch a little bit of volatility, protect my money. I'm not going to be making money necessarily, but the big old loss that I have to wake up to on my options and deal with the next day, I've already started to pad that loss. So it can just be a really, really good tool for protecting your money, hedging your bets. If you can't trade all day, then you can do some of this trading in the evenings, or you can do some of this trading in the pre-market. And one of the things I will say, always be aware of when some of the always be aware of when some of the other markets come online, whether it's your European markets, some of your Asian markets, because you'll often see volatility around those times as their markets open and they do some futures trade, US futures trading. Always be aware of those times, but as a whole, you can find yourself having a lot of safety going on when uncertainty happens at night. It's more rare. You're typically going to have pretty controlled movement overnight. Oil is, of course, going to be your standout, but generally over the night on your ESs, your NQs. Another one I haven't mentioned, YM, it's the Dow. You're going to have more controlled trading. You're going to kind of, be rejecting where you think you should be rejecting. Normally, you would think you would be bouncing where you think you're going to bounce, but we got some selling going on right now, but you'd still be short down into it. So tends to be overall pretty technical trading when you're trading futures. That's really all I got on them. I want to answer some questions, and then I want to spend, the last 10, 15 minutes trying to talk about prop firms, advantages, disadvantages, things to consider if you're going to use them. Let's see, I'm realizing I missed some things here. Oh, Errol, did you get those NQs? So minis are $20 per $1 NQ moves. Micros are $2 per $1 that NQ moves. So easiest way to think about them, a mini's 20 shares, a micro is 2 shares. Just think of it that way. So we'll see if we got to that. Yeah, Raphael, exactly. A lot of the time, it's very, very technical in these after hours. Don't get me wrong. As we start coming into, you're gonna have this kind of stuff happen. You're gonna have craziness happen in those after hours. I think that's after hours. I don't know. But you're generally gonna have pretty technical trading, and you're generally gonna have ranged trading more than anything else. This type of stuff at night is very, very common. And so always just be aware when those other ones come online. Like I said, Europe or Asia or any of those places, when they start trading, be aware because that's when you can, pick up some additional volatility, things like that. And maybe find yourself in a bad place or a good place, and sometimes you'll get a nice little trend down, or trends up or whatever it is in the after hours. But for the most part, you know, be prepared for some ranged slash a little bit of trend, slow grind up, slow grind down kind of stuff is going to be much more common. Yeah, Scotty, you're exactly right. Oil is like as shady as it can possibly be. It really is the shady one. But there's some money to be made there. And if you are big on oil and you listen to oil and you understand what's going on with OPEC and the Americas and all of those things, it can be a really, really great place to make a couple of bucks. That's for sure. But it is uh you know, it can be a fun one. I don't trade oil often. Personally, when I trade futures, I'm almost always going to be trading ES, NQ, or the Dow. Those are the ones I like to trade. But if I'm, in full disclosure, I don't like trading futures. It's not really for me. I love options. I love the funny things you can do with options to kind of, sneak in some good entries, sneak in some good exits, sometimes you can make a little more than you think you were going to make on a move. I like options for that reason. Futures are fun every once in a while. For me, like I said, they mostly serve a purpose, either, scratching an itch at night or hedging if I feel like I need to. But beyond that, I just don't personally love trading them. Can I
Hey,
can I explain something with an example? I would love to, but I unfortunately am just seeing that message and I don't know what I was talking about when you asked me for that example.
hey, can I ask a question?
Yeah, absolutely.
Hey, so how does the futures correlate with options? I know oftentimes when people call out, some of the channels I've noticed, like Woxy, am I saying his name right? So
Yeah,
he
I don't know.
mentions,
Yeah, yeah, you're good.
so
You're good. Yeah.
he usually mentions like ES is holding this value pretty good. How does that correlate? For example, like ES versus SPX options.
So they're all going to be a little bit different. And I'm super happy that you're asking this question because I'm realizing that I left out an extremely crucial part in what I discussed. So something that you're going to notice, and we'll just pull them up. Give me 1 second. So something that you're going to notice is, technically speaking, um, SPX and ES are 10 times SPY. However, you're going to notice ES is at 66.96, SPX it closed at 66.31, probably somewhere around there ish, 66.31, and SPY closed at 662.26. None of these line up to a perfect 10 times like 10x thing of SPY. It's all because of slightly different calculations. The fact that ES is futures contracts, SPX is only options contracts. It is not, it is a non-tradable asset. You can only trade it through derivatives. You can't own shares of SPX. Well, SPY, you can own shares of, you can trade options of, and it's a weighted ETF. So Wax is interesting and it's actually funny. So for me, I watch the futures chart more than I watch the SPX chart. He's just treating them the same, doing his analysis on one over the other. I like ES because it moves in the after hours, so you get a little bit more information there. SPX, while it's tradable 24 hours most other places in the world, for some reason still not in America, the SPX chart quits moving after hours. So when you're trading, you just need to kind of, if let's just wax alerts, SPX calls on a hold of 66.95 or something on ES. Well, we're just going to zip over to the SPX chart and say, okay, well, that's 66.30-ish. Again, I'm just kind of making up these numbers. You just kind of have to look and take that correlation and know that the numbers aren't going to be the same, but understand he's playing a support right here. There's also a support going to show up on SPX. But the part, so I want to talk about this now, the part that I forgot. So, and pretty crucial part, it's unfortunate I forgot. So, SPX, you buy an SPX option, let's just say right here is your entry. You buy this SPX option right here. Well, when this thing drops down and then this thing bounces back up, um, 50-50 chance whether or not you'll be break even. That's you aren't get you might enter at 660 or 66.95.27. There's no, you won't necessarily be break even when we get back to 66.9527. Let's just move this. Like, give me 1 second. You won't necessarily be green at 6695. Well, on futures, if we are long right here, we are long at 6695. No questions asked. If we come back to 6695, we are break even every single time. And that's why it is more like shares than an option contract. Our break even is always our break even. So this aspect of futures makes them, while higher risk, because as long as it goes down, you keep losing money. An option has capped risk, unlimited reward, theoretically. But if you put in $300 into an option, you can only lose $300 on that option. Well, on futures, you get long at 6695, you lose as long as it goes against you. You lose more and more and more money. And this is always your break even, ignoring adding to trades, whatever. This is always your break even. So that's the big difference between trading SPX versus trading futures. Where this can be really nice for traders, say, and again, this isn't a trade plan, this is just what I'm using on the chart. Say we want to take a trade and off 6695, and we're looking for a bounce back to these highs. Well, we know we have a potential 10 points of upside. That's $500. Well, we can say, well, but I want my stop down here, 6687. Well, we can very quickly say, well, I'm risking, whatever this is, $8 to maybe make $10 upside. There is bad risk reward on that trade. So we can use that and we can analyze it very quickly and very accurately on futures. On options, if you aren't studying the Greeks, understanding that, the delta correlations, the gamma correlations, something like SPX, the IV correlations, you're going to have a hard time understanding how those things pay you. When people are trading SPX, they're basically just praying that that thing goes in their direction and they are going to sell when they have made money on it. They don't go into it with a lot of plan. Well, on futures, because they have that unlimited loss aspect of it, you need to have a much better formulated plan. Thankfully, because they're virtually shares, it makes it very, very easy to analyze risk reward. And so because of that, and I meant to say this all earlier, because of that, it can actually make micros pretty appealing to somebody. So when we trade SPY contracts, if we're trading an at the money SPY contract, we're going to have give or take 40 to 50 delta on that contract. Well, that means if SPY moves $1, we're making $50. Well, $1 on SPY is $10 on ES. So if we trade a micro, if we get a $10 move, we make $50. So a micro is very similar leverage to a single SPY contract. So it can be an okay way for people and to actually trade them and have a little bit of safety. Again, I'll go back to Tradeovate because it's the one that I like. If you want to trade micros, you only need $50 of margin, technically speaking. The issue is if you buy one and it goes 1 point against you, they're liquidating you. Well, if you put 250 bucks in there, which is a relatively small account, and you only trade your one micro, then that means that you can lose $200 before before they're going to liquidate your account. Well, that $200 is 40 points on ES and $4 on SPY. So nobody should be running $4 stop losses on SPY. So if you want to trade micros, it can actually be similar to futures or similar to SPY options. However, you have to respect your stop loss because the loss never stops until you exit. Whereas, an option goes to zero and it doesn't go past zero.
Okay. Well, so the follow-up question then is, is it fair to, like, when I want to trade the SPX, put the ES chart as well, like side by side, just for learning
It's
the futures going forward? I'm
so
still learning options. I'm not into
it
futures,
doesn't
but
matter. It doesn't matter what chart you watch. As I said, I like to watch the ES chart. Tilio watches the SPX chart. So I won't say either one of us is right or wrong, but I will say you don't necessarily need to watch ES and SPX. They're like,
okay.
they're kind of the same. I will say first, I don't think anybody should trade SPX. I could get into it why, but that's not for this lecture. I don't think anybody should trade SPX. However, I will say if you were going to trade SPX, if you actually have a portfolio that supports trading SPX, fine. I still think you should trade SPY. You'll make more money. But having the SPX chart up, if you're trading SPX, will be helpful for your brain. Say, you buy this dip on SPX, you're looking for a move back to 66.42 and you want to be in a reasonable contract. I of course don't support those like 30, 40, $50 out of the money SPX contracts. You know where you are, you know where you want to trim, and you know what contract you should be buying. Because, say, and this is just a completely random example. We're buying this dip at 66.30. Well, if we're watching ES, we might see the 66.95. We might get confused on, what price am I trying to buy? What price am I targeting? 6,700? And then I go back to SPX and I'm like, well, no, I'm looking for, 66.42. So if you have ES up and you're trying to trade SPX contracts, your brain could easily get confused. I, again, am in no way supporting people trading SPX. I, in fact, think you shouldn't. However, if you were going to, or I was going to, I would personally have the SPX chart up so that I would, have better ideas in my head of my contracts of where do I get the money and things like that. Just the main reason to not look at ES is strictly a confusion thing. You can of course watch whichever you want. You can use the option chain to tell you where the SPX is. But if I was trading SPX and actually trading it, I would personally be watching the SPX chart. But you don't need to watch them both, at least in my opinion.
Okay. No, thank you. That
Yeah,
that's
yeah,
a good explanation. Thank you.
perfect, perfect. So any more questions? Rudy, I love to hear that. Any more questions? Nope. Okay, we're good. So final thing we're going to talk
Yes,
about.
I do have
Oh,
a question. So, how do
yeah.
you do the after hour hedges? Can you explain that with an example, like some news comes out, something like that?
So one of the best examples, let me see. Let's see. So one of the best examples, give me a second. I have to look, because I didn't prepare this. So give me 1 second on getting my examples ready.
Sure, sure, take your time.
If it was this one. So I'm using this one because oh wait, no, it's so I'm using this one because it's something that I actually did. So I okay, so and you guys are gonna laugh at this. So into Oracle earnings, funny enough, I kind of thought that the market was gonna slide on us on the back of that Oracle earnings. I know I've just been wrong on that thing. Like I'll just put it out there. I've just been, my opinions of what have happened on Oracle have just been wrong. So funny enough, this is Oracle earnings day. So I swung short because I kind of thought that Oracle might set us off on a little bit of on a little sell-off in the market. As you can see here, it was up 50, $60, whatever it was. Well, I knew that my shorts were going to get obliterated. So I got on and I traded this pullback and this bounce on NQ. And that's all I did. It was short-term hedging because I saw Oracle explode. I said, okay, this market buys on the back of anything that is even remotely good news. Market's going to go up is what I told myself. Once I saw this move, I said, market's going to go up. So I got on. I happened to catch a little bit of downside on NQ. I think I just traded this little pullback right here. And then as we pulled back to, because I trade everything the same. As I pulled back to this previous support, I likely have this level on my chart from trading that day. I bought this dip somewhere around here, $10 or 10-point stop on it, and was able to catch a nice pop. My QQQ puts that I swung opened at zero. Oh, well, probably not zero, but down bad, we'll say. And I was able to protect it right here. And so it was just one where I was wrong and I was able to say, okay, I need to make a couple of bucks to cover what I did wrong. And trading micros, I wasn't trading minis or anything like that. Don't get me wrong. If I was trading minis, this 30, 40 point drop would have plenty covered my QQQ puts. But I was able to protect myself a little bit right there. So this is, again, one random example. It's something that I actually used it for recently. And that's the only reason I could think of this one. And so, like I said, I just had a feeling once that good earnings came out that the market was going to buy into the next day. I believe it did buy into the next day. Yeah, here's our open ripped. I guess we dumped right before the open and then ran right away. And so my thought was market is going to buy. I was wrong. I should get on there to protect my money a little bit. It wasn't about, trying to make a bunch of cash. It was trying to cover the couple $100 in QQQ puts I swung. That was all it was. So, I mean, another time could be CPI reports, as I said, any of those things, but really any time big news comes out in the market. One of the last ones, I couldn't go back and find the date, presidential elections, when there was debates going on, I would trade them at night. And you would get those reactions based on what people said. So I could have my bias from the debate and swing a little bit something on what I thought the debate might result in. But I was able to get in there and do a little protecting and a little bit of trading during the debate. So it's really just, you don't know when the opportunity is going to present itself, but you have that ability to do it if you need to, or if you want to, or you can always just let your trades die or run or whatever it might be. But when that news comes out, or a news release is coming, or maybe earnings come an hour after close instead of shortly after close, you're able to just get on there and do a little bit of protecting. Don't get me wrong. It can absolutely go wrong. You can get in there to protect some money and lose extra money, but it's a nice little way to be able to say, I was right or wrong. I expect a certain move in the market and let's see if we can get it.
Got it. So this Oracle after hours earning at 4:30 or probably 4 it started popping up, and then did you have to like come on here immediately and do your hedging, or like is this
Yeah. And that's what I'll try to do. I'll try to get on and trade it while I think things are happening. Or even, on this one, I mean, this move I wasn't planning on trading for a long time. I wasn't even I wasn't going to swing hedges. I wasn't going to put hedges on or anything like that. But I was able to say, okay, I know when this news is, I know the news that's going on, I know how this market is likely going to react to this. So I am able to go on and react. Another one, and this is for, I can just use this example. This isn't something I did or anything like that. And this is for, I mean, I don't know how, like, uh, I don't necessarily know. Let's see, give me 1 second. I gotta look up another date. So another one, let's see, where are we now? Here we go. I should have been able to get this one. So even though volume is high, volume's high right here. This was actual market open. So this is where market open. So this is the CPI release. So something that you could do here, and again, I'm just on NQ, you could do it on ES, you could do it on Dow, whatever you wanted. Say you swung long because we were going, you swung long, you had long positions open, but you knew we had CPI or PPI coming out the following morning. Well, as we're coming into the CPI release and you know that you're long, you can put a hedge on, somewhere around here, any of these bounces up into here, you can put a little hedge on short. And maybe you get this move and maybe it works great for you. Or maybe this thing just goes the other way and it explodes and you can stop out. But you knew you were long in your position, you knew you had long positions, say you're swinging long SPY or tech or whatever it might be. Well, maybe you want to jump on here and put on a micro or two and see if you can get some volatility to the downside. This was one where, I mean, obviously we knew CPI was going to go up a little bit as it did. So you could, but we also knew that if it wasn't a huge increase, the market was still probably going to rally. The market will rally on anything right now. But this is a perfect time to kind of show up, put a little hedge on. Maybe it works, maybe it doesn't, but you protected your money and maybe you luck out and catch the $100 downside candle on NQ, or maybe it bounces against you, 40, 50 points and you lose some money, but your longs are going to cover that loss. That's the thing about hedging. Best case scenario, your hedge goes worthless and you make a ton of money on the other side of the trade. Worst case scenario is your hedge pays you nice, but it doesn't even cover the losses on the other side of the trade. So that is always the double-edged sword of hedging, is that technically speaking, you are hedging to lose money. If a hedge works properly, you don't make money on the hedge, like ideally you were right. You ended up not needing the protection, and that's where you make the real money. A hedge is just there to pad a little bit of the loss. That's really all you're looking for.
Got it. Makes sense. Thank you very much.
Yes, absolutely.
Hey, out of the topic, is there like a session or from Woxy we can get, or is it already like a recorded session on his call outs and things?
No, there is not. He's a newer analyst. I gotta be honest, I've tried to talk to him a few times. He's just not the best at responding to my DMs personally. So we didn't know all he traded was SPX. We thought he was a swing trader, and like traded individual names. So we didn't really know that all he trades is SPX. But he trades, I mean, just like most other people do, he trades support and resistances. The thing with him is he has an extremely high risk tolerance. I'm not saying it's a good or a bad thing, but a large majority of those SPX trades involve an average, so he tries to be a momentum trader. That's what he's looking for. He looks for continuation in directions. But no, we don't have any lectures from him or anything. I'm sure we could maybe try to put one together. But like I said, he's a hard one to pin down, that guy.
No, but I love his call outs. I've been following his SPX call outs for at least like the last 3 or 4 weeks. And I know it's a high risk involved, and instead of trying to do the SPY, I've been trading with him on SPX, and on
Well,
an
and
average,
just so just remember,
he's pretty spot on.
so just yeah, I mean, don't get me wrong, most of them come back and play, but 75% of them, 70% of them, he averages, but like I will tell you right now, you will make more money trading SPY dollar for dollar. You know, there's a reason that really rich people don't trade SPX. You know, the big money and they're really rich and they're great traders. None of them trade SPX. They trade SPY. It provides substantially more safety, and more often than not, it provides much better risk reward, and oftentimes more money dollar for dollar. You know, I'll see him. You know, he alerts an SPX contract for $600 or whatever. And you know, it's awesome when those things, you know, bounce $100 a contract or whatever it is. Well, for that very same price, you could have likely got 10 contracts of SPY. You know, his SPXs, thankfully, they aren't super far out of the money, but they are always out of the money. You could have got 10 SPY contracts at the money for the same dollar value, that your delta is going to increase. You will actually start making more money faster on SPY than you will on SPX. Of course, you can't buy one $50 SPY contract and one $500 SPX contract and expect the same thing. But 10 of those SPYs will 9 times out of 10 pay you more than SPX. They will also provide you the ability to trim contracts, so you don't just have to hold your one and pray. And they will also, when it goes against you, whole position will have a smaller percentage loss than SPX will. You know, you'll get that one SPX wick against you that drops your contract, you know, 20, 30, 40%. That same wick on SPY will drop you 15%. So all traders go through a phase of SPX, and then they all go to SPY eventually. You know, there's a reason that big money. So how do you figure out the equation? So if you see, and again, you know, I don't mean to speak for Wax or anything like that, but let's just say, I mean, let's see, what did he alert today? So he alerts a $700 SPX contract. You could have got so doesn't matter. You know, he's alerted an SPX contract, so it calls. So what do? You go to SPY and you buy the at the money contract for the exact same value. You know, it doesn't matter what it is. But you know, it doesn't, you know, like if he alerts, you know, say again, right here, he alerts SPX contracts, say he alerts 6700s. Well, you're going to go to SPY and you're going to say, okay, I'm buying the 662s. You're going to buy the at the money strike. How do you make more if it's going your way, but lose less when it's not going your way? Because of delta, because his delta is so high. And, you know, when his delta is $50. So if it goes $2 against you, you're losing $100 on that trade. Well, on SPY, that's the equivalent of 20 cents. So you're only going to lose 1/5 of one delta, and it is almost always going to be less than SPX. Because those contracts are so valuable, they're so heavily affected by IV and things like that. The losses are always larger on SPX than they would be on SPY.
Yeah, makes sense. Thank you.
Yep. And you know, I'm always happy to give, you know, examples and things like that. I unfortunately don't have them pulled up right now or anything, but 90% of the time you will make more money or lose less money on SPY. There is times and places where I won't say SPX makes sense, but there's times and places where, of course, SPX will make you more money. But generally speaking, it can be these end of day things where, and this is again getting way too technical, but you know, if you buy these 663s, they might pay you nice. Well, one of the advantages to SPX is you actually basically wind up with a mid strike, you know, because you can buy, you know, on SPX, you can buy your 660 30s or your 660 35s or your 660 40s. That's on SPY. That is similar to if you could buy 662s, 662 50s, and 663s. So when it's end of day and you have an easier ability to wind up in the money, that is where an SPX contract can, even though it's a total lotto, you have a very good chance of losing it all. They can potentially pay more, because the greatest thing you can do is wind up in the money. That's the most powerful thing you can do on any sort of option contract, is go from out of the money to in the money. One of the big advantages of them is they, you know, you are provided more leverage at no additional cost to you. So if you're trading a, $25, $30, $40, like people do, out of the money SPX contract, but you're trading at the money SPYs, well, you might get the $2 move or the 20-point move on SPX, which is going to pay you nice. Well, that $1 move on SPY, once you're in the money, you get in the money and you move another dollar, you're going to be making massive money. You're making, $60, $70 per $1 SPY moves. SPX is not, you aren't going to be in the money. Your delta is going to be lower. So you end up making a little bit less. And I will say, it's not like I'm telling you, you're going to, you're going to make a mountain more on SPY, but you're going to make some percentages more on SPY more often than not, and you're going to have less risk doing it. I have this conversation a lot. This is, we have these cycles in OOT every, little while. People find SPX, they think they're the goats, but in reality, they're losing everything to SPX. What I always tell people is, look at your year to date on SPX. If it ain't green, never trade it again. You will do better on SPY. I can guarantee it. Okay, well, if that's going to do it, I think we're going to call it a night here. I know we didn't talk prop firms. We'll come back to that another time. But thank you all so much for being here. Yeah, Ninja loves SPX, and I guarantee you Ninja's year-to-date SPX is one of the reddest in OOT. Yeah, we can talk about OPEX for just a second. There's not really much to talk about. It's when all option contracts expire, VIX contracts expire, futures contracts expire. So it doesn't necessarily mean big moves. People always, they'll say, oh, boring OPEX. Well, most OPEXs are relatively boring. You often get some early day volatility followed by end of day volatility that is oftentimes in a very tight range. And so what's going on in OPEX, big money, hedge funds, market makers, all those guys, mutual funds, they aren't trading weekly options. They aren't doing that kind of thing. They trade, monthly options, quarterly options, things like that, because it's time and it's safe and, it's the smart way to trade options. And so what we see on OPEX days is a shuffling of money. It'll be them selling some trades and sticking with the trade and getting into new contracts. It'll be closing some trades and not getting back into them. What's oftentimes fun for us is we get to see where money kind of shuffles to. Like here a couple of quarters ago, well, I guess end of last year, it's been a while now. We saw a big kind of move out of tech. We saw a lot of money going into financials and energy and, small caps and names like that, and less big orders going into tech. And ultimately tech went on a little bit of a sell for the next quarter. Obviously still ended green, but it wasn't a great quarter for tech. So, this one is the quad witching quarterly expirations. So it's a bigger one. There's oftentimes a lot of money involved. People have been sticking with these trades for 3 months, 6 months, 9 months, they've been in these trades for a while. So when the quarterlies come up, we often do get to see a pretty big shift of money. You're going to see these gigantic numbers thrown around on Twitter and all this nonsense, $1 trillion of notional value. Well, I mean, sure, maybe there's $1 trillion in notional value. That does not mean there is $1 trillion in open options. What that actually means is they're multiplying the value by 100 because each option represents 100 shares. So you get this wildly inflated number. People say, oh, huge notional value. And it is. I mean, it's probably, $1 trillion or whatever, 800 billion bucks, something like that. But it's just the options are expiring and people will go into new things. It doesn't mean the market's going to fly, $50 or dump $20 or anything like that. It just means that big money are closing and entering. No, it definitely does not usually trigger a sell-off at all because, they're going to put their money right back to work. So, and because options, options selling and buying doesn't have any, well, technically speaking, has no effect on stock price. It doesn't, it won't move the market like that. Stock price affects option price. Option price does not affect stock price. And while they are selling positions and closing positions, they're buying billions of dollars of new positions as well. So that's why you oftentimes will see that range movement as buying and selling occurs. But no, definitely, I mean, no, I've been part of insane upside moves on OPEXs and insane downside moves on OPEXs. There is no rhyme or reason, there is no rhyme or reason to what's going to happen. We just have to trade the market as we see it and try to follow some of that volume that we see coming in. Okay, well, that's going to do it. Thank you all so much, everybody. I appreciate you for being here, and we will catch you all tomorrow. Great questions. Let's have some fun. Fridays, casino day, and we will catch you all later. Thank you.